Namaste viewers. Erstwhile Escorts Mutual Fund was taken over by Quant Group in 2018. Since then, the assets have been growing, and today they manage an AUM of around 10,000 crores. I mean, within a short span, their growth has been phenomenal. Many of their schemes, Quant Mutual Funds schemes, are way ahead of their respective benchmarks and peer group. On July 20th of this year, 2022, the Quant Mutual Fund is coming out with a NFO, new fund offer, in the large cap category. To know more about the offering, let us hear it from the horse mouth. And for the same, we have none other than Mr. Sandeep Tandon, founder and CEO of Quant Mutual Fund. Prior to Quant, Sandeep has worked in pivotal positions with ICICI Securities, Kotak Securities, Repco, and Economic Times Research Bureau. Good morning, Sandeep.
Very good morning, Namaskar.
Welcome. Yeah, welcome. And it was glad meeting you a couple of days before when you were in Chennai last week.
Yeah.
And it is really good to see you again on behalf of our subscribers. Now you are coming out with a large cap fund NFO, and I know that in many other categories like large and mid cap category or pure mid cap category, small cap category, ELSS, many of your funds have done phenomenally well by the way you manage the funds. And now you are coming out with a large cap category. Here I have my own doubts, as well as many of our subscribers and investors will have their doubts. So just on behalf of them, I am putting you some questions. First thing is, do you think is this the right time when world is crumbling on Ukraine war, America increasing interest rate, and India inflation going up, world over inflation going up? So is this the right time to launch a NFO? Will investors make money by investing in the current environment?
So it's a very interesting question. Obviously, I personally believe this is the apt time for a large cap NFO, particularly for the people who are looking for stability in their portfolio, given the noise which we have seen in last many months, and if their risk profiling is on the slightly on the lower side. And anyway, 3 weeks back, we have talked about that reflex rallies on the card. I think that has just started, and always the reflex rally which we are looking at, the first will be come through a large cap space, and we have a very strong view, given despite global turmoil which we are facing, and we are extremely cautious and concerned about the long-term inflation, long-term interest rate, particularly in the developed market, where India is relatively slightly isolated. So very near-term perspective, it is also affected, but from the medium-term perspective, we are seeing extreme level of negativity. This noise of a narrative of the inflation, extraordinary interest rates, I think is speaking out now, because I strongly believe this was not a demand-driven inflation. It was supply-related, constraint-related inflation we are seeing. We are seeing commodity prices correcting. We are seeing logistic issues are getting sorted out. Okay, so extreme pessimism which was there. See, despite that we have concern, but I always believe that no moves are going to be linear. So we believe that the second half of 2022 should be far superior than what the first half of 2022.
Okay, good. Generally, the other thing is, say like, will there be any difference between the large cap schemes that are currently available on the market and your new offering?
So I tell you, if you look at our own track record in last 3 years, when we started implementing the VLRT framework of September 2019, and we predominantly have a mid cap and small cap or combination of such schemes, and they have givenly clearly outperformed the market. If you look at the Sharpe or Sortino ratio or any risk adjusted returns ratio, look at, we could be the best in the industry. Okay, with that background, we believe that definitely we can do a better job in the large cap, because our style, as you know, is managing money through a dynamic style of money management. And we also talk about how we'll use our VLRT framework to implement, which is the case we have already demonstrated. But in a large cap, the advantage is that the dynamic rebalancing, when we talk about, can be better optimized, because the stocks are very liquid. So you're talking about dealing with a large cap names, you're dealing with a good amount of liquidity, and hence the impact cost is low. So dynamic rebalancing strategy is going to be very effective in the sector or the stock where the impact cost is significantly low. That really help us in doing a sector rotation very easily. So it is a very apt product for us. But I have seen in the industry, as you rightly said, that A lot of funds have underperformed. I think that the way I look at, most of the funds actually try to mimic large portion of their portfolio towards the particular benchmark, and the smaller amount is used to manage in active manner and try to generate alpha. If you have a large portion deployed in mimicking the indices, and some of the sector, let's say banking, has underperformed for the last many years with the largest weightage, then it technically it becomes very difficult to outperform the market. So in our case, since our thesis is dynamic style of money management, we are going to be really actively managing this portfolio, and we have demonstrated this thing in the past. So we remain very confident this product should also will generate alpha for the investors.
Okay, good. One more thing, when I was just going through the list of funds available in the large cap category, because now it is not only actively managed large cap funds, there are index funds, there are quality large cap, quality 30 index funds, so and so on. So when I put the list, it shows me around 150 schemes in the large cap category, either benchmark hugging or benchmark or actively managed. So, I mean, I feel that it's kind of overcrowded market, and why should someone invest in large cap category at this point of time?
I tell you two things. Since I just want to talk about, it's also about when a lot of passive product has been launched in the market, and I have seen sometimes position in such a manner that they are less risky. It's a passive product. So I think we want to clarify the passive or the index product or the ETF will never able to outperform the benchmark given the negative tracking error they have because of the the fees which you have to pay and the costs associated with that. So that is one myth we want people should understand, that that is the one risk aspect out there. Second is a very important. I said that why we should invest in our quant fund. So we will be investing our 80% of the portfolio in the large cap, which is by the definition from the regulatory point of view or SIT perspective. So we not only generate alpha in this 80% dynamic manner, we manage money. Another 20% we have a flexibility. Either we can deploy these remaining 20% in the Nifty 500 stock to generate alpha, because sometimes there will be cycles where mid and small can also do particularly. Like we are slightly more bullish on the mid cap space on the current level. Also, we think that could be also opportunity. Another important aspect which we are bringing is about the using the option, because in last many months the option volumes have actually increased significantly higher than the futures volume also. So now SEBI allows us to write 20% cover call in the Nifty indices or the Sensex stocks. Okay. So this is some opportunity we are trying to generate additional alpha, and we have a lot of experience in this space. In the past, we were one of the largest player in the derivatives market. So we think we have edge, and this is also not done on a continuous basis. We'll be writing calls. It is only on the opportunity base. Whenever we see either sector or stocks is speaking out from a near-term perspective, and we want to maintain our core holding from a longer-term perspective, those are the areas we will start writing options and trying to generate extra alpha from a near-term perspective. And this is something which can be easily generated. So we are very confident of bringing this feature, which is there, but the industry generally don't use it. So we want to highlight that. We will be very openly, I'm saying that we'll be using this in a big way.
Okay. Now, next question you touched upon, the question that I'm going to ask you is, say, like very few large cap schemes, which you also agree have outperformed the index generally. Pure large cap schemes, like which hold 80% of things in the top 100 stocks. Then why should an investor go for an active fund instead of a passive fund? Because anyway, many of those schemes are not outperforming the market. So how will be different? How you will differentiate that? Are you confident that in the sense the things will be better than, and you will be able to manage or generate returns better than benchmark?
That's an interesting way we look at, if you really look at the genesis of passive fund has come because most of the currently active managed funds are also managing their fund in a very passive manner. Okay. So real question comes, why to pay a higher fees for us a quasi-passive product? Okay. And that's the way the passive product has grown. So two important things we have to understand from the passive, which is I was talking about in the previous question, that is myths to say that they are less risky. The risk profiling, whether it's active fund or the passive fund within a particular equity scape, or let's say in large cap, and this thing remains the same. the passive fund or the ETFs will never able to outperform the benchmark by the way it is designed because of the cost structure and the tracking error. Okay, so it is again a myth when we say that we have potential to outperform. In our way, the way we look at that, this entire positioning, we are trying to create a index plus type. It is our endeavor, okay, to generate index plus return. Now, how it is possible? Because within that 80% of the portfolio which we are investing in a large cap, we think we have ability to generate alpha by rotating our portfolio in a sector rotation, because we manage money in a very dynamic style. Okay? When we look at whenever we are talking about either the valuation is getting stretched or liquidity is stretched or risk appetite is stretched, we have ability to rebalance our portfolio in a better manner. Okay, this is the edge which we bring on the table, whereas compared to other fund which is predominantly unidirectional and they're just looking at the valuation analytics. So we give only 1/3 weightage in the valuation analytics of model. 2/3 is the macro. And what is very important to understand, any valuation methodology use their derivative of price. Okay, so when prices are affected, it is a straight away linkage because they are derivatives of prices, where our 2/3 macro parameters are not derivative of prices. It gives me a far superior edge in terms of understanding the global macro environment starts. We are one of the reasons why all our schemes have outperformed the benchmark significantly in last 3 years is because of this framework which we have implemented. So we remain very confident that the framework which has proven in the good and bad cycles also, and we have seen a couple of cycles and it's played out quite well. So it's a philosophy which we follow, and this helps us in maintaining our being relevant as a philosophical approach here.
Good. I understand. Then one more question, last question, and I will let you go then. So the thing is, active versus passive. There is, if you open any social media regarding investment in India, many times, as usual, we try to copycat US market or UK market or any developing market. So many of the people on the social media, they are saying, invest only in index funds. That is safe and that has low expense ratio. Warren Buffett has said that index fund is the best. Now I have asked them then why he is not investing in index fund. He himself is an active fund manager. So here I want your clear-cut thoughts whether in India active funds can do well or can't do well. And again, it depends on the manager, the fund house, all those things. But general, your thought, because you are an experienced person in the fund management and you are a successful person as well. So your take on active versus passive, which way investors should go?
I think the way I have looked at, for most of the firm is an additional product on their shelf, So we have seen the extraordinary growth of active fund, and now the new wave of passive has started. So I call it as a marketing gimmick, which is being played out very well. And a lot of people believe this is less risky. The risk profiling remains the same. There is no, I'm saying minor risk can change depending on the portfolio, but broadly equity risk on a large cap remain as it is both in the active or as well as the passive is concerned. Okay. But the real strength of a money manager really comes into picture even if we can generate alpha in the challenging environment or even the difficult environment or even the easy environment. If we can outperform the market, the business is all about outperforming the market in a big way. So I think it is depending on the individual strength which we bring uniquely on the table, we remain very confident, our product style of money management which we bring, the active fund, the way we manage our products, I think this large cap should also generate similar alpha what we are able to generate in our other schemes.
Yeah. Across the board, I have seen, that's what, you are way ahead of benchmarks and all those index funds. It's really heartening to see that, and hopefully this large cap fund also you will do well. I have full confidence and full faith in you. And good luck for your new fund offer, and see you another time soon in Chennai.
Thanks a lot.
Thank you.